what's the best kind of life insurance to have? The kind that is in force when you need it. I didn't have living benefits. I got hurt in a nasty car accident and it completely destroyed me financially.
You're a certified living benefits expert. What does that actually mean?
Policies where people can access the death benefit in the event of a critical, terminal, or chronic illness.
How realistic is that?
You can have up to 75% of your death benefit, and that comes in a lump sum. I've seen a claim as high as $872,000 paid out.
The most interesting thing to me is life insurance as an investment vehicle.
We can't call it an investment. Cash value life insurance is the most powerful financial tool on the planet. The problem today is that's not how it works.
Jason Hansen, thank you so much for coming on. I'm really excited to kind of dive in with you, but I want to quickly introduce you and, kind of why you're on the podcast today, which I'm really excited to dive into this topic because it's been confusing for me. And I consider myself semi-intelligent. And every time I talk about this subject, I either feel dumber or I don't know. I want to cut through the crap and kind of get some answers here. And I think you're the right guy to help with that. So I want to introduce you to everybody. So you're a certified living benefits expert. My bad. So talk to me a little bit about that. Like what does that actually mean?
So there's certain life insurance companies that have policies that include living benefits at no extra cost. A lot of times when I say living benefits, people think I'm talking about whole life and somebody accessing the cash value when they get sick or they get hurt. That's not what I'm talking about. I'm talking about policies that have actual benefits built into the policies where people can access the policy, the death benefit in the event of a critical, terminal, or chronic illness, also critical injury. Those things are very important. I have dozens of testimonial stories about people that have accessed their policies and it completely changed their financial trajectory. I have my own story. I didn't have living benefits and I got hurt really bad in a nasty car accident and it completely destroyed me financially about 30 years ago.
So when we're talking about like life insurance, right? I met somebody like 10, 15 years ago and they're like, you need life insurance, right? And it's like, well, okay, well, let's kind of figure out like how much I need. And like at face value, I was kind of like forecasting my life as it was then, my kids and like how they could sustain a lifestyle or operate in the event I'm no longer able to, right? Like to me, it's pretty basic stuff. But then I think this is where it all kind of gets confusing. Because part of me is like, I forget what the amount is, but I'm paying a certain amount per month. But then I'm looking at it, well, if I just made an investment, it's just very confusing as to, and then you got guys that are like, well, you can actually use this as an investment vehicle, put X amount away every month. And I'm like, what is it, right? There's whole life, there's term life, there's this other investment vehicle that these guys are talking about to use it to pull cash out at a later date, like borrowing money from yourself. So can you just explain, like, if you're walking around as a human and if you're running a business, like what is life insurance, like what does that mean, or like what should you start to think about like to protect your assets?
Well, people always ask me what's the best kind of life insurance to have, and my answer is always the kind that is in force when you need it. So there's term life insurance. You mentioned term. Term is for a set number of years, either 10, 15, 20, or 30-year term policies. Much less expensive. As we get older and we need to renew them later on in life, they get much more expensive. Permanent is more expensive in the beginning, but the permanent policies that I work with, they stay in force until you are 120 years old, and you can usually pay for them in about 20 or 30 years. Sometimes you can pay for them in 7 years. Sometimes you can pay for them in 10 years. So there's a lot of different ways that we can structure a policy to make it work for you. Obviously a term policy doesn't have any cash value in it, but as I mentioned before, the term policies that I work with include the living benefits, which means you can access, in the event of a critical illness or injury, you can access up to 75% of your death benefit. If you have a terminal illness, you can access up to 90%. And chronic illness, you can have 2% per month. That's the big deal. If you have $1 million policy, that's $20,000 a month for chronic care.
I've never heard of that. My experience with life insurance is like, all right, here's what's going to happen when you die. Like,
Yep.
how much do you need? Do you need $1 million, $2 million, $4 million? And this is what happens, right? But you're saying that if something happens, right, and you're still alive, like, are these special kinds of policies, or are these applicable to like every policy that people have access to?
Not every company offers these robust type living benefits. There's just a few companies in the industry that offer these benefits.
Because what I want to ask you direct, right? Like my world is entrepreneurs, and entrepreneurs get so hyper focused on just building their company, their employees. A lot of them don't take a lot of money along the way. They're reinvesting every dollar back in the company. So like the big part of their nest egg is the company. Right. Then you have the other entrepreneur that's like making a lot of money ongoing, right, through income or capital, distributions. But from your perspective, I know a lot of entrepreneurs that just haven't done anything. It took a while for me to like do something myself, but now I'm learning new information from you about, hey, if something happens, and my dad just went through an experience, like you just never know what can happen.
Yep.
So like, how do you like look at an entrepreneur like myself? And I know everybody has unique situations, but like, what do you recommend just with your deep expertise in this field that entrepreneurs should be thinking about, and how to structure and set this up the right way?
Well, first of all, how much money do you need to, if something were to happen to you, how much money do you need to sustain? We can do the math and figure out, all right, if I'm down for a year, if I'm down for 2 years, if I'm down for 5 years, I'm going to need X amount of money, and we can figure out, how much death benefit you need in order to generate that money for you. And you're right. Most entrepreneurs are hyper focused on growing their company, and they don't take the time to think about, if something happens to me, how am I going to fare financially? And so it's pretty simple math of being able to plug the numbers in and figure out, how much death benefit do we need to generate, in order to get them a payout if something happens to them. And hopefully, real quick, hopefully we can get them through that event and they can continue on, in their career.
So how does that work, right? If somebody has a policy and, God forbid something happens, an accident, and I think you had mentioned you have a story to share about that. Like, is it something where like, a traditional payment's around $500 to $1,000 a month, and you're buying a $2-3 million policy, and you mentioned like there's a portion of that policy that you can get back? Is it, talk about that. You're talking like 20 grand a month or 30 grand a month, 40 grand a month. Like, how realistic is that? Because these entrepreneurs have because then you also have like key man stuff you have to deal with. If you're not, there's company stuff, there's personal stuff. So you should probably increase what you think you need, because there's always the surprises and additional funds you need. But can you talk a little bit about that? Because I think it's really interesting. Like, I've never heard of it. Just curious around your thoughts about that.
Well, like I said, with the critical benefit, you can have up to 75% of your death benefit. So you got $1 million policy, you can have up to 750,000 of it, and that comes in a lump sum. The terminal, you can have up to 90%. So $1 million policy, you could have up to 900,000. And you mentioned realistic. I've seen a claim as high as 872,000 paid out for a guy that was terminal, and it actually, the money didn't extend his life, but what he was able to do with the money, he was able to go to MD Anderson in Houston. He had one of those glioblastomas in his brain. He was able to go to MD Anderson in Houston and get some ancillary treatments that actually extended his life. I mean, he did pass away, but when he passed away, his family was set because they had already taken that money and done what they needed to do to be able to carry on for their lives. And then, the chronic benefit, and it's important to note that it's a chronic benefit. It's not a long-term care benefit. I can't call it long-term care because if you can't do 2 out of the 6 activities of daily living, which are toileting, transferring, feeding, continence, bathing, dressing, um, you can have 2% of the death benefit. So $1 million policy, you'd get 20,000 a month out of it. That's going to go a long way for somebody. And I always make the joke, something happens to me, my wife can put me in the shed in the backyard and have a nurse come by and check on me once a week and take the money and, I don't know, spend it on her new boyfriend,
Her new
right?
boyfriend. Now,
Right.
is that in perpetuity, or does that only go to the amount of the
It
actual
goes to the
policy?
amount of the policy. So it's for 50 months.
Okay. Interesting. Yeah, I've never heard that, honestly. Like, and I've always thought it was just like life, death. Like, here's what happens when you pass, right? But talk a little bit then. I think the most interesting thing to me is like the whole, life insurance as an investment vehicle.
Yikes. We
Can you
can't
shed some
call
light on that?
we can't call it an investment. Cash value life insurance is the most powerful financial tool on the planet. Um, the problem today is the YouTubers and the TikTokers that are touting it as being more powerful than it really is. In other words, somebody gets on TikTok and says, "Oh, you can put 100,000. You can put $100 a month, and that's going to create $1 million for you. In the next few years." That's not how it works. Um, Permanent life insurance, like I said, is very, very, very powerful. It's very flexible. You've heard of infinite banking, be your own bank. And that's what they're talking about. They're talking about permanent life insurance, where you can access the cash and the policy at any time, at any age, for any purpose. We sometimes call it a Roth IRA on steroids, where the money's growing non-taxable, so there's no tax being paid on the growth of the money, and then you can access that money back tax-free, like I said, at any age for any purpose. Now, it takes more than $100 a month to be able to create a policy that you want to do that with. Real estate investors use these policies all the time. They put large quantities of money into the policy and then access the money back, maybe to buy a property or renovate a property. And, when they sell the property, or when they're renting the property out, they can put the money back into the policy, and it grows that much faster. I'll give you a small example of how I've used mine. I've got a son that he turned 16 2 years ago, and we live in Nebraska. So what does every 16-year-old kid want? When he gets his driver's license, he wants a pickup, right? So we found one and went and looked at it and took it for a drive. Uh, I asked him, I said, "What do you think?" He said, "I really like it. I think I want it." I said, "All right, let's talk to this guy." It was a farmer, a little ways away from where I live here. Um, I said, "Let's talk to this guy and see if he'll let us give him a check to hold on to it for us." So we asked the guy, "If I write you a check for $500, will you hold on to the truck until we can get the money and come back and pay you?" He agreed to that. So this was on a Saturday. We went home, and um, we had started a policy on my son about 10 years ago. Um, Actually, it was longer than that. He was 4 years old when we started the policy. Anyway, we started the policy way back then. And so we called the life insurance company on Monday, said, "Hey, we need X amount of money out of his policy." They said, there's no questions other than, "Would you like that EFT or check?" 2 days later, the money was in our account. We went and paid the guy cash for the pickup. And Now, when we got home, I said, now, Davis, what you're going to have to do here is if we would have gone to the bank, they're going to want you to pay that back. Gone to the bank, got a loan. Obviously, you're going to have to pay that loan back. And so what you need to do is you need to pay this back into your policy. You need to put money into your policy every month. And so that's what he's doing. And his policy is going to grow that much more. So that's kind of a smaller example of how I've actually used mine.
So you're basically taking a loan from yourself, essentially.
Right.
So like, let's kind of dissect that a little bit. I love that it's at small scale, so it's super easy to understand.
Right.
What if he doesn't pay that back? Right? He's like, hey, I'm good. Like when I die, I die. Like it's not my money anyway, and I don't want to pay that back.
Right. You don't have to pay it back. It's gonna lower the death benefit and the policy. You're gonna lower the cash that's inside of the policy, and you're gonna shrink your death benefit a little bit.
But it's still like, so the money he puts back in, the money he generates, that's still going to be classified as income, or is it not?
As far as taxes,
Correct.
no, it's tax free when it comes back out.
But going in, it's you're always going to be taxed coming in. The money coming out, it's already taxed, correct?
Correct. Just like a Roth IRA, the money's taxed before you put it in. Then it grows with no tax and comes back out tax free.
So from your opinion and expertise, like what's the benefit then, right? Like if you would have set your son up with like say a basic, account of, investing in the S&P 500 or whatever vehicle you're using, right? In a stock versus him pulling from there to use that money, like what's the biggest difference?
Well, the tax benefits, obviously. Oh, my brain just did something.
But the tax benefit, like, help me understand though, because if the money going into it is already taxed, the money coming out, like, there's no taxable event. But like when it's a stock, you're going to have to pay on capital gains,
correct,
or a loss.
Correct. So the first thing I want to talk about there is these policies. The way they work is they credit interest into the policy based on what the index does. And let's use the S&P for easy example, and that's the most popular one. So let's say the S&P goes up 8% one year. They credit your account 8%. Say it goes down 8% the next year. That year you would get a zero. It has what's called a 0% floor on the policy. So anytime the index goes down, you don't take the loss, you get a zero. Now, sometimes I get some pushback on that. People say, wait a minute, you want to offer me zero on my money? Well, if we could rewind the clock back to 2008 when the index dropped 54%, zero would have been your hero, right?
Yeah.
And then anytime it goes down, it usually rebounds pretty well in the next year. Say it rebounds 12. Well, again, I said the floor is zero. So if something has a floor, there's usually a ceiling. For my example, let's say the ceiling is 10%. So you give up that 2%, they only give you 10%.
Interesting. So like what's the vehicle then? Because I see like you talked about like real estate, individuals using this. Like, is it get the max amount of death benefit that you can possibly get based on your health and how much you can afford? Like how do you determine that? Like if I'm like, hey, like I want a nice distribution for my family if something happens, but along the way, I mean, I kind of look at this as, do you really want to use this as like a HELOC, a home equity line of credit, or like some type of vehicle to move stuff in and out of, or is it, what's your take on that?
Well, for obviously life insurance is a long-term play. Permanent life insurance is a long-term play. That's where people get in trouble is, they stop contributing and the policy eats itself up. Now, after a certain point, that's not going to happen. After a certain point, there's going to be enough cash in there to sustain the policy. And you talked about using it as a HELOC. Usually get a better interest rate on a life insurance policy. So, um, ask me that question again, Wesley. Sorry.
Yeah, no, I'm just thinking about like using it. Again, I'm thinking like from where I sit as an entrepreneur and just entrepreneurs in general, right? There's always costs or things or opportunities or real estate or buying the son's vehicle, whatever that may be. And you either need to like dip into your checking account, right, and do
Right.
this, or you need to tap into some type of an account,
Right.
right? So the traditional way is probably like, do you have an E-Trade account or do you have like a guy managing your money,
Right.
right? So my question is, if I need life insurance anyway, right? If something's going to happen to me, can I play that along the way if I want to buy a $200,000 down payment on a house I'm going to flip? And
Right.
I've got 5 kids and I've got 3 vehicles this year and whatever. Like, is that a good tool or does it just kind of complicate things or get you in trouble? And does the IRS approve of that or not? Or
It's a great tool, and the good thing that the one of the most wonderful things about life insurance is there's no umbilical cord to the IRS. Absolutely none. So you asked the question, should I get as much death benefit as I possibly can? What we usually do is we will create a term policy as well as a permanent policy so that if the living benefits are needed, we take the money out of the term policy. But yes, create as much death benefit as we can in the permanent policy so that we can grow as much cash in that policy as we possibly want to. I've got a doctor that puts 650,000 a year into his policy. He's running himself into the ground, and that's why he's doing this. Um, he's going to put 650 in a year for 7 years, and then 3 years after that, he's going to be able to retire and have a nice tax-free income. So there again, it's very, very flexible. Um,
so tax free in the sense of let's just stay on that real quick. So help me understand, and I'm understanding properly. So this calendar year, I'd pump in $650K into the life insurance policy.
Yep.
I do this every year for 6 years. So I'm paying the tax on the money as income.
Yep.
But when it goes into the life insurance policy, it's there.
Yep.
6 years, I'm like, hey, had a good run. I want to retire. I want to live off my life insurance benefit. So I can take distributions from that as I see fit.
Yep.
And if I understand correctly, if it's tied to the index, and let's just use the S&P,
Yep.
if it's 8%, it's growing along the way.
Yep.
And if we have a crap year, if the market's down 12% negative, I have a safety net at 0.
Correct.
So again, I'm no mathematician, but like 8% growing at that's a decent clip of cash. Now, when I pull that out, there's no tax liability on that growth gain.
Zero. Correct. That's why it's so powerful.
So let me ask you a different so what's the strategy then for you, for somebody like, hey, like if I, like right now, I love a stock right now. It's called VOO.
Okay.
Nobody take my advice on any of this, but it's a Vanguard index fund, right? And performs really well. But like after talking to you, it's like, well, there's a lot of risk with stocks and mutual funds, right? It can go to 0 and below. So why wouldn't I pump all of my money into a life insurance fund where I have that bottom protection versus, the traditional way of buying stocks through E-Trade or having just like normal financial investment vehicles?
Well, life insurance is a tool. If we've got a 9/16 bolt, we're not going to tighten it with a 7/8 wrench, right? So it's a tool, and we talk about using buckets, right? With life insurance being one bucket, in your case where you're managing your own money, and you're doing halfway decent, it depends on how much risk you can afford to take. And that usually has to do with somebody's age. The older we get, the less risk we want to take. So, I encourage people, if they're getting a match, I'll use 401ks as an example. If they're getting a match, take that match, contribute to the match, and anything else, let's take it over here and let's put it into a life insurance policy so that you can have some tax-free cash as well as, your tax deferred tax cash. I have a great story about that. I don't think I do a lot of drawings and pictures and things like that. We'd have to get back together to look at that sometime. But, we talk about the tax buckets. One bucket is our tax bucket. That's our wages and income and all those things that we pay tax on as we earn it. If we don't, the IRS will chase us down and throw us in jail. Then there's the tax deferred bucket, 401k, IRA, 403b, all of the number, letter, alphabet soup of tax codes. And then there's the tax-free bucket, municipal bonds, Roth IRA, and then life insurance. So I encourage people, I wouldn't shove everything into a life insurance policy, especially if you can, like I said, if you can tolerate a little bit of loss. And if we're young enough, take advantage of those big gains in the market while we're young. But then as we get older, maybe start shifting it more into the safer bucket.
Yeah, because if I, just looking at it simply, if I have, let's just say $1 million in, a mutual fund that's making 8%, right? That's $80,000 a year.
Right.
If I pull that out before 1 year, I'm taxed at max, Uncle Sam, right?
Yep.
And then if I go beyond a year, like that money is at what, 15% or whatever.
Right.
But if and say I want to buy like a piece of real estate, for 80 grand. Now, if I have that life insurance vehicle and the money's in there, I can take that money right out with no tax implication whatsoever.
Correct.
And I have the flexibility of backfilling that or not. Are there caps on these policies and how much money you can stuff away?
Nope. There you can grow as much money as you want. Matter of fact, one of my business partners had a conversation with a billionaire in Colorado. Guy's worth $8 billion. He actually has 19 permanent life insurance policies that he uses. So there's no cap on the number of policies you can have, and we're not limited as to how much cash we can put into it. That's one thing I was going to talk about with, Roth IRAs are great, except, there's that umbilical cord to Uncle Sam, as well as, if we're under 50, we can put 7,000 a year into it. If we're over 50, we can put a whopping 8,000.
And there's income required, correct? I mean, if you make a certain amount of income, you can't even invest in them, right?
That's exactly where I was headed. If you make too much, you can't have one. And you have to wait till you're 59 and a half to access the money tax-free. Life insurance policy, we can access the money anytime we want, tax-free, no questions asked. And I've started several policies on kids when they're 10 days old to get them started when they're young and their insurability is still there. We can use the money for college. We can use the money for a car. Like the example I used, we can use the money for anything we want later on. So we're not limited to an accredited university like you are in a traditional 529 plan.
So if you start that when they're 10 days old, right, or whatever, very early on, is that what type of policy is that? That can't be a term, or is that a term, or is that
No,
that's like is that just like that policy's in perpetuity?
Yep, it's a permanent policy.
So what's something like that? Like, just give me an idea. Like, I have 5 kids, or an entrepreneur has a kid. You're not thinking about a life insurance policy when your kid's born.
Right.
But maybe you should, because you can use this as a different type of vehicle.
Right.
I did the traditional stuff it in a 529, play that game, right? But how do you, is it like $200 a month, $500 a month? Is it like, how do you determine, is it just what that overall net end value is?
Yes. Well, and we can start as low as $25 a month, which is not going to do much for somebody, but it'll create a little bit of cash for you. The ceiling is how much insurance do the parents have. They usually won't let me go over $1 million on kids, $1 million of death benefit. Now, I should back up and kind of explain what I mean by that is if I pull up my software on the computer and if I plug in a number, that will tell me how much death benefit that will generate for me. So $100 a month, then, say it generates 400,000 on a kid. So it's flexible as well as, like I said, we're kind of limited there on kids. And the parents have to have at least as much insurance as the kids.
So what happens then if you, like, let's go back to your doctor that's shoving $650K in this thing. If something happened to him on year 3, is every dollar invested added on top of that death benefit? Or is that like, how does that shake out? Or is that's the risk you take?
Right. You get the death benefit, but you don't get the cash and the death benefit. Think about it like this. If I have a $500,000 house and I have 200,000 of equity in the house, when I sell that house, I get 500. I don't get 700. Does that make sense?
Yeah.
Okay. That's the easiest way to look at that.
So that's probably it then, why you wouldn't put all your eggs in that bucket, because if something happened to me and I have my other financial account, right, like that's getting passed through.
Right.
Right. So what's like a good balance then? Like, 10%, 20%?
Usually the 100 rule where when you are, let's say you're 25, that means 25% of your assets should be somewhere safe. And then as we get older at 50, then 50% of our assets should be somewhere safe. So, one thing we should always do is create an emergency fund. And that's the, shoving money into a savings account. So it's there if the hot water heater breaks or we got to pay a deductible on a roof or whatever. And then, from there, then we use the rule of 100.
That's an interesting concept. I've never heard that. So like that makes total sense. So if I'm 43, it's like, okay, 43% of my assets should be very, very safe.
Yep.
Is that the concept?
Yep.
And life insurance falls within that bucket.
Yes.
But then you got to figure out that, hey, if we are using this vehicle to invest and something happens, because I'm kind of thinking about, like, say that death benefit's $10 million.
Right.
But if I'm dumping in $650K a year, something happened prematurely. If I put that $650 in a different account, I'm still getting that $10 million death benefit, and they're still getting the other capital from the other accounts.
Correct.
Versus, like, if you put all that into life insurance, you would just get the 10 million. That's
right.
It.
Correct.
I get it. So there's probably a little bit deeper strategy there.
Right.
Yep.
But again, it's the most powerful financial tool on the planet. It's one of 3 tier 1 assets. Cash, gold, and permanent life insurance are all 3 tier 1 assets. Matter of fact, I'll tell you a story of Walt Disney. You know how Disney World got started? Walt had filed bankruptcy, I don't know how many times before he decided to open Disney World. And every bank that he went to try to get some money to start Disney World turned him down. Finally, one banker asked him, "Well, do you have any cash value life insurance?" Walt said, "Yeah, I've got some of that." And that's how Disney World was started, was because Walt Disney had some cash value life insurance, even though his credit was horrible.
Wow.
Yeah.
Interesting.
Yeah.
Interesting.
Very powerful.
So how do you make the decision, right? I mean, there's a million different things out there, right, that are super confusing,
right.
Super complicated. There's guys out there, gals, like peddling policies, annuities, life insurance. It's like, well, how do you know you're not getting bamboozled? Like, what are some tips and tricks for people to do their due diligence to make sure they're doing the thing that they believe in?
Right. If a guy is trying to sell you really hard, stay away. One of the things we do is we educate. My goal is, like I said earlier, I draw stuff on a legal pad, and I explain things that way. My goal is to have somebody point to my legal pad and say, "May I have some, please?" I don't feel like I have a right to sell anybody anything, because let's use this example. If I owned a used car lot and you came in to look at one of my cars, you took it for a drive, you come back, you tell me you like the car, guess what? You're not leaving until we sign the paperwork on that car. If I've got to get somebody to hold one arm behind your back while we sign the paperwork, then that's how we're going to do it. That's about a 5-year commitment. The strategies that I work with will affect you for the rest of your life. It'll affect the people that come after you, maybe even the people that come after them. So I don't feel like I have a right to sell anybody anything. My goal is to educate you and facilitate what you ask me to do for you.
Yeah, because I feel like there's so much out there, right? Like, so like, how do you identify, like we talk about like the S&P or some type of index? Are there like certain types of policies that just stand out versus others? Because it's just, to me, it's like super confusing unless you're like in this space. Like it's all Greek to people. Like nobody can really be like, oh, I fully understand this and I spent a ton of time. I mean, that's what you guys are for, right? Like you guys have the expertise, but I do feel it's like product dump overload, right? Like it's just, yeah, it like overloads.
And that's why I talk about concepts instead of product. Makes it much easier to digest it for people if we talk about concepts instead of, pulling up an illustration and, looking at each little line and here's what this means, here's what this means, here's what this means. We talk in concepts instead of product, because you start talking product, after a while, somebody's eyes glaze over and you've lost them.
Yeah.
Because you're right. It can be very, very confusing, but we keep it very, very simple. And that's what makes us stand out, is because we focus on the education piece, and again, concepts. That's the easiest way to help somebody understand how these things work.
So one last question then. So like I have a policy right now. I pay a certain amount per year. Now, if I didn't, in the case of like how to use this for like to build your account, the company that I have, I think it's called Guardian. Like they tell me how much the policy is.
Okay.
So like if in this model, if that person just pays that fee, nothing above and beyond.
Right.
Is it a 5-year, 10-year clip where now they start to get access to capital, or is it only if they contribute above and beyond that minimum payment?
It depends on how we set it up. If we set it up to really, really overfund it, so to speak, you can have access to the cash right away, or a portion of the cash, about 80% of the cash. But usually, again, like I said earlier, life insurance is a long-term play, and it usually takes about 7 years for somebody, 5 to 7, depending on how the market does. Right, market does really well, then it's going to grow their cash faster. But 5 to 7 years, and then about that 11-year mark is when it really starts cooking.
Awesome. Well, Jason, thanks so much. I learned a ton. I was very interested in kind of diving deep in this topic. I think it's a confusing topic. Definitely added some clarity. Now, if people want, like, how can people get in contact with you if they have questions?
Jason at midwestfamilyfinancial.com is my
Awesome.
email.
And we'll put all that in the show notes too. But Jason, I really appreciate you coming on and sharing your knowledge. Definitely helpful. Gave me some insight. So I really appreciate it. Thank you so much.
It's been fun, for sure.
Awesome. Thank you.
Thank you.
This has been another episode of Entrepreneur Intel. Thank you for joining us. For show notes or other episodes, please visit us at entrepreneurintel.com. Until next time.